Welcome back, guys, to another video. So today the discussion will be about NFP and trading news events, basically. So yesterday we had NFP. The date was, what was the date? The 6th of September. So I'm sure you guys saw that, most people were not satisfied with the results of NFP and how it went down. So today we will be breaking down, focusing on silver, right? So a few things happened. So let me just go ahead and erase my setup so I can actually explain what really went down. So we won't be touching on nasdaq and whatnot. We'll be solely focusing on silver alone. So as you guys saw that with the metal pairs, just like gold and silver in this case, NFP actually, it looked like it went up, but then with gold, it first spiked down and then went up, right? Which is a conflict of interest. When you are in a buy position, it literally might have taken you out with that spike down, and the opposite with a selling position, you might have had a sell position. It sold for a second and then bought, right? Probably took you out as well. So guys, we should be honest about trading these news events, right? Because they have so much hype around them, a lot of hype, right? And to be honest, this is the 15-minute time frame. Let me just do this. You can see that this is basically the movement of the news event, which is so small. And the fact that people they wait a whole month or weeks just to trade this news event, and this is the results they got. So you must look at the value of trading these fundamentals, guys. This is a very small move compared to how you would have capitalized off this huge movement to the downside without the news event, because this is the aftermath of NFP, right? And you can see it went probably like triple or quadruple the size of what NFP did, which is just this little move. And the thing is, you guys full margin this small movement and then you blow, and then next thing you see a huge movement after the news event, which just shows, like, guys, I'm not saying avoid trading fundamentals, but here I'm just here to discuss the value of preferring trading normal days compared to like just trading fundamentals, right? So with silver, we had so I'm gonna start from the basics. We had a pullback right there, right? This point, this pullback is a place of interest. As you can see, it is the reason why the price rejected right there. And right after the rejection, the price sold off and then started correcting, basically moving sideways, being range bound right there. And this correction was actually kind of tricky to spot out. As you can see, I have a little note right there, and I'll touch on that just in a moment. So typically you get your support and resistance, but then if you can see that, it looks like we have a few number of touches there, because if you actually use a horizontal line instead of a trend line, it gives you a few touches. So let me just erase that for now. It looks like we have this as a touch, we have this as a touch, we have these two as touches, that, and then here it broke out and then went back down, right? So this would confuse your average skilled trader, right? You would think, oh my God, there's so many touches, and Chris Hendricks usually says the third touch has the highest probability, and if we count, this would have been our third touch, so we would have expected a sell right there, but then the price kept ranging, and then it broke out the upside, and you'll be like, dude, what is going on? The third touch theory is not it's not working. But since this is we can't really tell using your normal chart candlestick, right? Your candlestick charts. So we had to divert to a line graph. So a line graph will really tell you what is what. So if we can just adjust this, even though when we're selling, when we're selling, we only focus on the resistance. So if we can draw and connect our peaks, it looks much simpler. So here we have the first peak, second peak, third peak, which is our third touch. So now we're back to our 1, 2, 3 touch theory, where the third touch is the one with the highest probability. So on the third touch, we want to spot our reversals. So our reversals will be your engulfings, your morning stars, your evening stars, your dojis, and so on, right? Because there's so many, but then just to list a few. So now we can go back to the normal candlestick chart, and what we have here on the 15-minute time frame is we have, let me just move this up, we have what we call evening star, which is a selling reversal candlestick. It shows that we are gonna sell. So remember, the news event was this bullish candle, this one. So you can see it went up and down basically. So just hold on. So it went up and down, spiking down and spiking up as well, which is very unfortunate because those who sold, they were in profit for a split second and then bought, and those who bought blew their accounts by the first spike to the downside, right? Very unfortunate. Mixed. I just don't know, bro. Like I wouldn't prefer trading news events if things like this keep happening, right? But anyways, we had our reversal right there. So this was our reversal candle, and then right after this reversal candle, we had a nice bearish candle to the downside. So this bearish candle is what we will refer as your confirmation candle. It confirms the reversal candle, or you can just simply call it your momentum candle, because it shows momentum to the downside. It shows the change of direction. And so these two, you use them in combination to actually confirm your entry, and then that's when you execute your trade. So the close of this confirmation candle is when you are supposed to enter your sell. So the reason why we're selling, remember, the market moves in two phases, right? It moves in an impulse, correction, impulse, correction, impulse, and it goes the opposite with a buy, right? Or an uptrend. So that's the reason we had this impulse, correction, and we're expecting the impulse to the downside. So would put our stop loss below above the body of the candle. Usually we would have it above the highest point, but then since this will be way too wide, this will be way too wide for our stop loss, which will mess up our risk to reward ratio. So we'll just simply put it above the body and instead of the wicks. So you can see this was a huge trade. This was, the major support. And, it was a solid 1 to 6 trade, meaning if you are trading, risking $100 with this one trade, you times it by 6, and, you'll simply make $600 with a risk of $100. But then if your stop loss gets hit, it means you lose that $100, because that's what you'll be risking, or that's how much your stop loss will be. So you can compare the small buy of NFP compared to the actual setup without the news event. It's a 1 to 6, and that small movement we had during NFP, it was, it's not life-changing compared to this. This, if, for an example, if you are YOLOing 10,000, for an example, 10,000 ZAR into one trade, simply you're going all in. 10,000 is your stop loss. Times it by 6, since it's a 1 to 6 risk reward ratio, basically 1 to 6.23. You typically make maybe 70,000 in profit. So this is just a testament that sometimes don't fall for the hype of trading news events. You will make way much just trading your day-to-day setups. First of all, they pay a lot more, because the huge movements compared to the small 1 second or 5 minute movement from the news release. So don't really follow the hype, but then if you do want to keep trading news, this is just me advising you to show you the other side of just trading a day-to-day setup, without factoring in any news events. So that's it for today's video. Catch you on the next one.